$600 million. That is the leverage wiped off the map this Tuesday between your first sip of coffee and the moment you burned your tongue. You felt that vibration in your pocket, that specific frantic buzzing pattern from your exchange app that never brings good news. It's the digital equivalent of a wake-up call you never want to receive. You pulled your phone out, squinting against the harsh light, and saw a sea of red so deep it looked like a crime scene. Crypto down double digits in a single hourly candle. Tech stocks diving like they forgot how to fly. And right in the center of your screen, your portfolio balance flickering, shrinking from a respectable number to something that won't even cover your grocery bill for the week. You froze. The air in the room suddenly felt 10 degrees hotter, a prickling heat crawling up your neck. You weren't just unlucky. You were Liquidity's. Let's cut the fluff so we can stop pretending this is a game of chance. If you try to catch a falling knife this week because some guy with a rented supercar told you to buy the dip, you didn't just lose cash. You provided the exit door for a whale who is currently laughing at you from a yacht. You looked at that chart, saw the price plummeting vertically, and your brain trained by free courses from 5 years ago screamed that it was oversold. You slapped the standard indicator on the screen, saw it dip below 30, and told yourself it had to bounce. That is like standing on train tracks and assuming the train will stop because you're wearing a safety vest. The market does not care about your lines. It is a machine designed to move money from the impatient and the emotional directly to the algorithms running the show. You saw a setup, didn't you? A neat little consolidation pattern right before the drop. You drew your trend lines, convincing yourself that support was holding. You placed your order, feeling smart, feeling like a sniper. And then the candle didn't just break support. It smashed through it like a wrecking ball through wet paper. It didn't even pause. It triggered your entry, dragged you into the red instantly, and hunted your stop loss with a precision that feels personal. It feels personal because it is not because there's a guy in a suit targeting you specifically, but because you behave exactly like the rest of the herd. You put your stop loss exactly where the code knew you would. You are predictable. You are a statistic. And in the last 48 hours, that predictability costs you a chunk of your net worth. Think about the sheer velocity of that 1 minute chart. Zoom in on it. Look at that long, nasty wick at the bottom of the crash. That wick represents millions of traders screaming in unison. It represents forced liquidations. It represents the hope strategy failing miserably. You probably sat there as the price ticked against you, bargaining with the screen. If it just goes back to break even, I'll close the trade. But the price just kept grinding lower, tick by tick, draining you until you couldn't take the pressure. You panic sold at the absolute bottom. Admit it. You clicked that red button right at the tip of the wick, desperate to save the scraps of your capital. And the second your order filled and you took the loss, what happened? The candle flipped green. The price shot back up like a compressed spring. It recovered half the drop in minutes, leaving you sitting there with an empty account and a sick feeling in your stomach. This isn't a glitch. This is the business model. The market is built to induce maximum pain before moving in the intended direction. Those indicators you rely on are lagging data. They are telling you what happened 5 minutes ago. Trying to trade a high-frequency event with lagging tools is like driving a race car while looking only at the rearview mirror. You are reacting to ghosts. While you are waiting for lines to cross, the institutional bots have already executed thousands of orders, trapped the buyers, squeezed the sellers, and cleared the board. They see the order book. They see exactly where the massive retail traders have placed their safety net, and they treat that safety net like a target. Most people think trading is about predicting the future. It's not. It's about survival. And right now, you are walking through a minefield wearing clown shoes. Do you think the game is rigged? You're right. But it's not rigged against you. It's rigged against bad habits. It's rigged against the lazy assumption that a textbook pattern works during a global liquidity crunch. You are bringing a plastic spoon to a demolition derby and wondering why you're getting crushed. This week wasn't an anomaly. This week was a stress test, and you failed. You failed because you are trading what you want to see, not what is actually on the chart. You are trading your need to be right rather than your need to make money. And the market charged you a tuition fee for that lesson. Look at your results again. Really look at them. That red number isn't just money, it's feedback. It's the market screaming at you that your method is broken. You are sitting in a digital cemetery filled with the accounts of people who thought they could outsmart a supercomputer with a line they drew on an iPad. You are currently draining capital, and the big players are waiting for you to deposit more so they can do it all over again next week. But here's the twist. That massive drop that destroyed your portfolio was arguably the most profitable opportunity of the month. While you were panic selling, the top 1% were stepping in with buckets of cash. They weren't guessing. They were executing a protocol. They saw the chaos in the streets, and they didn't see fear. They saw a discount. They saw the liquidity grab for exactly what it was. And unless you change your entire perspective on how price moves, you will always be the one feeding them. You will always be the target. The question is, are you ready to stop bleeding and start understanding the trap? You have to strip the feelings out of this. Right now, you are looking at a fantasy. Picture a split screen. On the left, that is you. You see a double top, a support line, maybe a wedge pattern you picked up from a 3-minute clip online. On the right, that is the algorithm. It does not care about art or shapes. It sees math, it sees coordinates, it sees clusters. Specifically, it sees exactly where you put your safety net. The market is an engine, and liquidity is the fuel. To get from point A to point B, it has to eat orders. And the easiest meal is a retail trader who read the same book as everyone else and put their stop loss in the exact same spot. You think putting a stop just under the low is protecting you? You are basically wrapping your account balance in a bow and handing it to a bot. Let's break down the setup we saw this week. It starts with the bait. The big players know there is a pool of cash sitting right above a recent high. That is where the breakout traders put their buy orders and the short sellers put their stops. It is a gold mine, so the algo pushes the price up. One big, aggressive green candle. That is the hook. You see that bar jump, your heart starts racing, and the FOMO kicks you right in the chest. You think the rocket is leaving without you. You smash the buy button because you are terrified of missing out. You and 10,000 others rush through the door at the exact same second. That is the moment the door locks. As soon as that liquidity is tapped, the machine flips the switch. It needed your buy orders to fill its massive sell orders. The price stalls. It hangs there, teasing you, then violently rejects. It leaves a long wick, that thin line on the chart. That wick is the evidence. It marks the exact spot where retail traders got cleaned out. The price crashes back down, taking out the stops of everyone who just bought, speeding up the drop. You are sitting there, staring at the red numbers, wondering how the market turned against you the precise second you clicked enter. It wasn't bad luck. It was a scheduled transfer of funds. Here is the first rule of survival. Ignore the first move. The first move is usually a lie. It is a fake out designed to make you emotional. Go look at a raw chart of Bitcoin or the NASDAQ from the last 2 days. Turn off the indicators. Delete the RSI. Delete the MACD. Get rid of the noise. Just look at the price action. You will see the pattern over and over. Price makes a high. It pokes above that high just enough to grab the cash. Then it reverses and tanks. I looked at this setup over the last month. It happened 50 times. 50 times the market offered a fake breakout, trapped the bulls, and paid the bears who were patient enough to wait for the grab. If you bet on the breakout, your odds are terrible, about 30%. You are flipping a weighted coin. But if you wait for the sweep, if you wait for the trap to spring and fail, your odds double. That is the difference between gambling and being the house. You can see the footprint of the big players in the volume. Look at the bottom of your screen. When that trap candle happened, the volume likely spiked. That isn't retail noise. That is billions of dollars changing hands in a blink. That spike is the institution stepping in and saying, thanks for the discount. If price goes up but volume is quiet, it's a ghost town. It's a trap. But a violent rejection with a volume surge, that is the bank leaving a fingerprint. Stop trying to call the top. You aren't a wizard. You don't have a crystal ball. When you try to short a rally in market just because you feel like it has gone up too much, you are standing on the tracks trying to stop a train with your hands. The market can stay irrational longer than you can stay solvent. We don't guess. We react. We let the market show its hand first. We let the rookies rush in and get washed out. Only when the dust settles and the candle closes do we move. We need to see the body of the candle close back inside the range. That confirms the breakout failed. Until that candle closes, anything goes. A wick can turn into a full candle in the last 5 seconds. You need to rewire your brain. Stop chasing green candles and start hunting for liquidity. Look at the chart and ask, where is the pain? Where would it hurt the most people if price went there? That is exactly where the price is going. It seeks out maximum pain. This week's drop wasn't a disaster. It was a mechanism to clear out the leverage. The board is clean. Now the real game starts. But knowing the theory is useless without a system. You can know how an engine works and still crash if you don't know how to drive. You need a protocol, a boring, repetitive checklist that keeps your hands off the mouse until the math is on your side. Without that, you are just a spectator with a front row seat to your own account blowing up. Open your trading platform. I don't care if it's a pro terminal or a glitchy app on your phone. You see a green candle moving up, and your finger is probably hovering over the buy button right now. Stop it. Take your hand off the mouse. Sit on your hands if you have to. We need to install a firewall in your brain to override the impulse to gamble. This is the exact sequence that needs to happen before you risk a single cent of your capital. Step 1 is the hardest thing for a dopamine junkie to do. Set a price alert and walk away. Find that resistance level where the price has been rejected 3 times this week. Don't guess. Look for the ceiling where the market keeps hitting its head. Right-click that line. Add alert. Now, stand up. Leave the room. Go make a coffee. Go stare at the drywall. I am serious. The biggest mistake is staring at the candles forming in real time. It hypnotizes you. You start seeing patterns in the noise that aren't there. By setting an alert, you stop being the prey. You set the snare and wait. You don't sit by the trap and poke it with a stick. When that alert goes off, maybe a ping on your phone or a siren on your desktop, your pulse is going to spike. You rush back to the screen. The price broke the line. Everyone in the chat rooms is posting rocket emojis. This is the suckers rally. This is where the herd piles in. You do nothing. You watch. You are waiting for the fake out. You want to see the price punch through that level. Trigger all the stop loss orders sitting just above it and then get slammed back down. You are looking for a long wick. That wick is the evidence of a failed breakout. It shows buyers ran out of ammo and got crushed by heavy sell orders. If the candle closes back inside the range, leaving that ugly tail sticking out, that is your signal. Now, the math, do not click buy yet. Grab the position tool. Drag the stop loss just above that wick. Drag the target down to the next liquidity pool. Look at the ratio. Does it say 1.5? Does it say 2? Trash it. If the risk to reward ratio isn't at least 1, 2, 3, the trade doesn't exist. This is your filter. Think like a casino. Betting $100 to make $100 is a coin flip. The fees will bleed you dry. But if you bet $100 to make $300, you can lose more than half the time and still print money. You can be wrong 60% of the time, look like an idiot all week, and still end the month green. That is the secret weapon. The pros don't predict the future. They just refuse to bet unless the payout is 3 times the entry fee. So the setup is valid. The math says 1, 2, 3. You click the button. And here's the reality check nobody shows you on social media. Sometimes, 10 seconds later, the market reverses and smashes your stop loss. You lose 1% of your account instantly. It's gone. Does your stomach drop? Do you feel the urge to double your position size to win it back? That is the sound of failure. A professional takes that loss like a business owner paying an electric bill. It's just an operating expense. You don't cry when you pay for electricity. You pay it because it keeps the lights on so you can sell your product. A stopped out trade is the cost of doing business. If you risk only 1% per trade, you can be wrong 10 times in a row, 10 absolute failures back to back and still have 90% of your capital left. If you risk 10%, you are 2 bad days away from flipping burgers. Let's look at the flip side. You execute the protocol. The price respects the analysis. It drops. It hits your first target. You don't celebrate. You don't order champagne. You move your stop loss to break even. This is defense. It means even if the market goes crazy right now, the worst thing that happens is you make $0. You removed the risk. You are playing with the house's chips. The price hits the final target. Balance increases. You didn't get lucky. You didn't feel the market. You acted like a cold robot executing a script. Real success looks like a boring spreadsheet, not a sports car. It's compound interest. If you start with $1,000 and follow this strict 1-2-3 protocol, the math goes parabolic. Most people try to turn that 1,000 into 10,000 in a week using maximum leverage on some garbage coin. They always go to zero. Always. But the guy who treats this like laying bricks one brick, one trade, 1% at a time, builds a fortress. He survives the crash. While everyone else got liquidated this week because they were emotional, the systematic trader was sitting on his hands, waiting for the wick, waiting for the ratio, and sniping the reversal. The market is a transfer mechanism. It moves money from the impatient to the patient, from the gambler to the casino. This protocol is the blueprint for building your own casino. It stops you from being the guy at the slot machine pulling the leva and praying for cherries. It puts you in the manager's office, watching the floor, knowing that over time, the math always wins. The system beats the sentiment every time. You can scream at the chart, pray to the crypto gods, or draw 100 lines, but the algorithm doesn't care. It hunts liquidity. If you don't have rules to keep you safe, you are the liquidity. You are the meal. This checklist is your shield. I'm dropping a link below to the PDF version. Print it. Ouchie. Tape it to your monitor. If a trade doesn't check every box, you don't click. Be the 1% who follows the rules, or pay the 1% who do. Like the video if you want to survive. See you on the charts.